The Federal Housing Administration does not actually lend money directly to borrowers, but instead provides mortgage insurance to private lenders to protect them against losses if a borrower defaults on the loan. This distinction is one of the most important concepts for the national portion of the real estate exam because questions often try to trick you into thinking the government is the source of the funds. You must remember that while FHA loans are insured, the VA loans for veterans are guaranteed. This government insurance allows lenders to offer more favorable terms, such as a down payment of only 3.5% for borrowers who have a credit score of at least 580. If a borrower has a score between 500 and 579, they might still qualify, but they will be required to put down 10% instead. On the exam, pay close attention to the Mortgage Insurance Premium, or MIP. FHA loans require both an upfront premium and an annual premium that is paid monthly. The upfront premium is currently 1.75% of the loan amount and can usually be financed into the loan balance. The recurring monthly premium is a common point of confusion because, unlike private mortgage insurance on conventional loans, FHA monthly premiums generally remain for the entire life of the loan if the initial down payment was less than 10%. This means the borrower cannot simply wait for their equity to reach 20% to cancel the insurance. When calculating qualification, the exam tests your knowledge of debt-to-income ratios. For FHA loans, the standard is 31% for the front-end ratio, which covers the principal, interest, taxes, and insurance, and 43% for the back-end ratio, which includes all long-term debts like car payments and student loans. A common trap on the exam is suggesting that FHA loans have no maximum limit or that they are only for first-time homebuyers. In reality, the FHA sets specific loan limits that vary by county based on local housing costs, and you do not have to be a first-time buyer to use one, though you can only have one FHA-insured loan at a time as your primary residence. To remember the insurance aspect versus the guarantee aspect of VA loans, use the phrase, FHA is for insurance. This reminds you that the letter I in insurance goes with the FHA, while the letter G in guarantee goes with the VA. Another trick wording to watch out for involves the FHA appraisal process. The property must meet certain minimum property standards regarding safety and soundness, and if the appraisal comes in lower than the purchase price, the borrower can still proceed, but they must pay the difference in cash, or the seller must lower the price because the FHA will only insure a loan based on the lower of the purchase price or the appraised value. You should also be familiar with the FHA amendatory clause, often called the escape clause, which must be part of the sales contract. This clause states that if the property does not appraise for at least the sales price, the buyer is not obligated to complete the purchase and cannot be penalized or lose their earnest money. The exam might try to trick you by saying a buyer loses their deposit if they back out due to a low FHA appraisal, but the escape clause specifically protects them. Finally, remember that there are no prepayment penalties on FHA loans, which is a common feature tested to see if you understand the consumer protections built into government-backed financing. By mastering the 31 and 43 ratios, along with the 3.5% down payment requirement, you will be prepared for any FHA-related question on the national exam.